My friends, let's do this. So, today's video is going to be a little controversial because I'm going to talk about potentially selling covered calls against your AMC position. The covered calls are taking a bearish stance against AMC and its current price action, but I want to explain why I believe that's not always a bad thing. Before we jump into the video, first off, the shameless plug: if you haven't already done so, please follow me on Twitter, Colin_Gladman. Easiest way to ask me questions, hear about any news that I see going on. Also, too, it's where I'm going to be tweeting out like more intraday ideas and chart ideas and things of that nature. Also, you guys know the deal. Not a financial advisor. Nothing I say is financial advice. Everything that I say is for educational purposes only. At the end of the day, you need to do what's best for you because you are going to be the one that is stuck with your portfolio. Not me, not any other dude on the internet. You are going to be responsible for it. So do what is best for you. I don't care if it's buying. I don't care if it's selling. I don't care if it's holding. I don't care if it's options. I don't care what you do. I want to be as clear as I possibly can about that. I do not care what you do. So do what's best for you. At the end of the day, make the decisions where you can put your head on your pillow at night and go, that was a good thing. All right. So let's jump into it. So I highly recommend going and watching Trey's Trades new video, and it piggybacks off of what Astro talked about. That guy Astro and Trades Trades are going to be their Twitter handles, and essentially what is finally coming to light, which I have been preaching since I have been on Twitter. I'm literally going to take the time at some point to go back and dig to find out the first time that I talked about it, because anytime anybody has ever talked to me about it, I have always said the reason market makers are always going to make so much more money than retail is because they don't care. They will ride the waves. When the IV gets really high and it's cheaper to buy puts, that's going to be the direction that they send the stock in, and so they're willing to play the upswings, they're willing to play the downswings, and they're willing to play everything in between, while retail is purely just I buy and I hold. Okay, and so that is why, for me, anytime through my technical analysis, the way I look at the chart, anytime I see potential downside coming in AMC, or honestly even upside, just not massive upside, I have always sold covered calls against my AMC position. Now recently, once we hit 100% utilization, and the cost to borrow was starting to creep up a little bit, even though it's still almost nothing. I did see that like the max got up to like 14% finally, and I think the average was right around 3%. But we need to see that going. But with short interest over 20%, utilization over 100%, and the cost to borrow creeping up, I said multiple times, be very careful about your covered calls if you are going to still be doing them. Now, full disclosure, I do not do covered calls against my entire AMC position. You have to have a minimum of 100 shares to even be able to write a covered call contract. And when you do that, like I said, you're risking 100 of your shares, okay? So depending on how many shares you own, that is going to be how. So let's say you have 600 shares, you could write 6 covered call contracts against those shares. And we'll talk a little bit about what are going to be some of the positives, what are going to be some of the negatives, where is all the risk involved with it. But I think cash secured puts and cash covered calls are a great trading strategy. It's essentially the wheel strategy. I do it all the time. If you go watch my BBIG video that I released a few days ago, it literally talks about that. I think the wheel strategy is a great strategy, okay? And it's because I'm starting to do more options, but I don't do a lot of options just because I hate what theta does to your options. So the time decay on those things, if you're buying more short term, okay? So if you buy leaps or anything like that, it's not as big of a deal. But if you even think about buying like short-term options or anything like that, once again, we all saw what happened last week. I bought options last week that they went from 350% in the money. Like that's how much I made. I made those positive 350% to minus 50% in like 4 or 5 hours, okay, when the halt happened, because it was crazy. So once again, they're a great way to make money and they're a great way to lose money. And the guy who taught me a lot about trading stocks, he always said, Colin, he goes, I got two rules. Rule number one is we don't lose money. Rule number two, you don't forget rule number one. And I actually think I've seen that quote attributed to Warren Buffett or something like that, but I feel like every stock quote is attributed to him at some point. But that really resonated with me. So we're not in this game to lose money. And so many people lose money because they don't understand the game. They aren't willing to play the game correctly. Okay, so this is going to be your first video where I'm going to kind of directly talk a little bit more about my strategies of how I do covered calls. This is what I'm teaching my son right now. Every single week for about a couple of hours, I teach him how to do all this kind of stuff. And so let's jump into it. Okay, so what I've got pulled up right here is on OptionStrat. So you can go to optionstrat.com. I'm sure there's lots of them out there, but I really just kind of like their interface and everything like that. So let's start with a covered call. So what a covered call is you pick a strike price, okay, just like regular options. So you pick a strike price and you are going to be writing a contract against your 100 shares. Okay, so let's keep the math simple. So today's example, we're going to do 1,000 shares. Okay, let's say you own 1,000 shares of AMC. So once again, you could write up to 10 contracts on that. And you could write each contract that you write, you can write them for different strikes. So this is what I'll do sometimes. So sometimes I'll do, a certain amount of the contracts that I do. I will do them at, a certain strike that's a little bit closer to in the money. Then some contracts I do a little bit further out. And then some contracts I do that I'm pretty much, unless this thing squeezes, I'm not going to lose these shares. But once again, it's all about collecting premium. So when you play options regularly, what you are doing is you are paying the premium, okay? So you are paying for the right to 100 shares. So, and don't take this the wrong way. Let's say if you don't have the capital to be able to afford 100 shares, you can essentially leverage 100 shares by paying a premium. So somebody out there is willing to be the seller and somebody out there is willing to be the buyer. The easiest way to think of it is like if you were going to buy a house. When you go to buy a house, you are, when you write a contract on a house, usually if I'm the one buying the house, I have to do a contract with the seller of the house and I have to give them option money. And that option money is the money that I'm putting down for the right to buy their house at a set price. Okay? So that's what you're doing when you play options. You are paying a premium for the right to 100 shares at a certain strike. So when you're on the opposite side of the trade, you are collecting option money and agreeing to sell your shares at a certain strike. And that's what covered calls are. So if you will, covered calls are like you own the house because you put up the money to own the 100 shares. Okay? So, excuse me guys, I'm a little worked up today. All right? Because some people just be pissing me right off. So, when you own your shares, okay, so let's say you own your 1,000 shares of AMC, selling a covered calls means I'm putting X amount of shares, let's say 3 contracts. So of your 1,000 shares, for 300 of those shares, you are putting them up for sale for a certain price, okay? And if you are AMC is going to, 500,000 is the floor for me type of moon ape, you ain't gonna like my videos, okay? Definitely not this one, all right? So, just like I'm teaching when I'm talking to my son, every single week, what I do is I approach my shares of saying, okay, at what price would I be willing to lose them? Okay. So at the end of the day, that is between you and your portfolio. Okay. I'm not going to get into exactly the strikes that I pick and how I pick them because I don't feel like that's the right thing for me to do because I don't want anybody to try to play my exact strategy. And if this thing squeezes and you get burned on some shares that definitely, or desperately just, had to have or anything along those lines, I just don't want you to be mad at me. I don't want that responsibility. Like I said, that's why I always say, you are the one stuck with your portfolio. So today, what I'm going to do is I'm going to use a hypothetical scenario. So hypothetically, let's say I have 1,000 shares of AMC. For me personally, this is one thing that I don't mind talking about. For me, anywhere, depending on how I'm feeling for that week, but anywhere between 20 up to 40% of my shares is what I'm willing to put on the line as far as these shares are for sale. Now, I have not been doing that recently, but if AMC doesn't show me some good positive momentum here pretty quickly, I will be going right back to them. Okay, so let me explain. So I own 1,000 shares of AMC. So the easiest way to do this, once again, is you can go build your strategy. This is what I love about Option Strat. You can go build your strategy, and it will tell you exactly what you're going to collect, what your max loss would be, what your max profit would be. So once again, we're talking about cash covered calls or a covered call because you already own the shares. So let's talk about this week, for instance, okay? So right now, AMC is trading at $21 per share. Here we are. It's Tuesday, April 5th, if you watch this video later on. So right now, AMC closed today at $21.21. So if on April 8th, if I woke up tomorrow morning and I sold a contract, a covered call contract, basically saying I'm willing to get rid of X amount of shares. So once again, let's say it's 300 that you're willing to do it with, and you say I am willing to get rid of 300 of my AMC shares so I own 1,000, so I'm willing to get rid of 300 of those shares, and I'm willing to do that at $21. You can sell a covered call against that. And for that, you would collect $133 worth of premium on that contract. Okay? So the 133 times 3, you would collect $399 minus a little bit in commissions. And that $399 would immediately go into your trading account. So when you write a contract and you collect the premium, that money is automatically put into your account right there on the spot. Okay? So what you're agreeing to is that if AMC closes above $21 on Friday of this week on April 8th, because you pick the strike price that you want to do along with the date, and you can change dates up here, all right? So you can change dates, but if AMC is over $21 on Friday, you are going to get assigned, all right? And that means, and your shares are, excuse me, you're not going to get assigned, your shares are going to be called away. So the good news is you collect the $400. The bad news is if AMC is over $21, you are going to lose those 300 shares. So at the end of Friday, if AMC was over $21, you would get 300 shares at $21. So you would get $6,300 sent back to your account. Plus, you would also have the $400 of the premium that you collected. So plus $399 would be $6,699. Okay? Now, once again, that's not going to be what the profit on the trade is going to be that $400 that you collected on premium. And it could also be, let's say those 300 shares you bought at $17 a share. So you would be getting from $17 to $21. You would be getting that money that the shares appreciated in value, plus you would be getting your $400 in premium. So you'd get the $1,200 that you made from 17 to 21, right now, plus you would get that $400 premium. So let's say you bought those 300 shares at 17. So those 300 shares cost you $5,100. Then you sold them at 21 times the 300. So that's the 6,300 minus the 5,100. So that's the $1,200. So you made $1,200 with the shares appreciating in value, plus you collected the $399 in premium. So you made $1,600 total on that trade. Okay. So let's say, Colin, you're freaking crazy, man. No way I'm selling my AMC shares for $21 a share. That's fine. Pick a different strike price. Now, the higher your strike prices get, so at 21, it's 133, 21.50, 112, 22. So the further you go out of the money, so the further away from where the shares are trading right now that you get, the premium is going to get smaller. Okay? So for me, let me just say this. So for me, and what I teach my son is I always try to collect somewhere between 1% to 2% a week for my portfolio when I do my covered calls and everything along those lines. Okay? Once again, I'm not telling you what to do. You trade your own plan, come up with your own strategy. And sometimes I don't even follow my own rule on that. I'll be as honest as I can. Sometimes what I'll do is I'll just go, okay, let me slide this bad boy around. What premium do I feel good at with the amount of shares that I'm putting on the line? At what premium would I feel good at? And then it is what it is. I'll do them at that price. Okay. Sometimes that's risking more shares a little bit lower than what I would like. Sometimes it's risking, my shares a lot higher than I like. Like right now, when we were running really hard, the IV was just spiking like crazy. Holy cow, could you have made a ton of money on covered call premiums? However, it's the old, well, when's this thing going to stop running, right? I don't know the answer to that. You don't know the answer to that. So that's why, if when we were down here, and if you sold a bunch of covered calls down here when we were in the $12 range, and let's say you sold a bunch of covered calls for 2 weeks out at $15 a share, you're going to be pretty pissed right now. Okay? So, once again, this is where you just, at the end of the day, you have to do what is best for you. But the market makers don't care. They will sell covered calls. They will do whatever it takes to simply ride the waves. Okay, so when the stock is ripping, they're going to make money while it's ripping. Right now, when it's dipping, once again, if you would have sold a bunch of covered calls, like right up here, when this bad boy halted, you could have made a ton of money on this drop right here. So, typically, when I like to sell my covered calls on AMC, it's just when I feel like AMC is looking exhausted. When it's looking tired, when it's looking weak, when the volume's low at tops or anything along those lines, that's when I personally like to sell my covered calls. Okay? But this is, why I keep saying at the end of the day, you just got to do what's best for you, and you got to live with the decision. So there are 2 times that I have lost shares doing covered calls on AMC. One of those times was, there was a week back in November. No, it was right here. It was in October when we had this massive run right here. I didn't think the accumulation was done. And I lost some shares at like $40. And it's right here. It ran up to like 43. And I lost them like right around $40. But that money went back into my account. And what did I do? I turned right around and I bought a bunch right back here, which at the time turned out to be a great trade. Now, like I've said, if you've been watching my stuff, this is where I thought we were going to run. It turns out that didn't happen. And so that's why my cost per share is still a little bit higher than I want it to be. However, on this move right here, this dump, I made a ton of money on covered calls on this big old dump right here. Okay. So when things were getting ugly, we were just busting through, our EMAs and supports and everything like that. Like I said, that's when you got to think like a market maker. You just got to go, hey, I gotta do what's best for me. I'm not just gonna sit there and watch my portfolio get smashed. Now, I made a lot of money, but also, of course, too, because I'm holding on to these shares, my share value decreased more than I made in the premium on the covered calls, but it definitely softens the blow, and I use that premium to collect, or excuse me, I use that premium to accumulate more shares along the way. Okay, so like that example that I gave on that $399, you can use that money to turn right around and buy shares with it. Okay, so that is what I do. I use my covered calls as ways to accumulate more AMC shares. I've also used it for GME shares, and I've also used it just for, I keep a certain amount of dry powder sitting around, so that way when I see plays that I believe in go on sale, I've got the dry powder to do it. So that is, so once again, both the good and the bad. You can make money on your position. You don't have to sit there and buy and hold. What's the risk? The risk is the squeeze happens and you lose some of your shares at a much lower price. Okay, so that's why, once again, I do not do covered calls with my entire position, and I don't recommend that you do it either. Okay, so I say this channel is not financial advice. If there's one piece of financial advice I'm ever going to give you, when you're in a play that's like a squeeze play, then hold on to a moon bag, okay? Because the reality is just nobody knows for sure. All my TA, it helps me predict very close to accurate price action, but it's not a crystal ball. We could wake up tomorrow and things take off. So, like I said. But I think covered calls are a great strategy, especially if you're like me and you don't like options from a standpoint of, theta decay and everything along those lines. Bottom line, when I buy shares at the end of the day, they don't go away. All right, not unless AMC is going to zero, and I don't think that's going to zero. When I buy the leverage against 100 shares, if the price action doesn't do what I want to do, then that money can go to zero. The money that you paid in premiums for options can go to zero. So buying shares for me is a much safer way to do it. Now, I think options are a great strategy. I'm not knocking options. I think they're great. They're just not my plan. Eventually, I want to get to the point where I do about like an 80-20, where like 80% of what I do is still buying shares and about 20% of what I do is options. And I'm slowly starting to creep into that. So, not knocking options, I'm going to be doing them myself. Now, another way that you can do this is you can do cash secured puts. Okay, so this is a bullish strategy. So, cash covered calls is taking a bearish stance against AMC. Cash secured puts are taking a bullish stance against AMC, okay? Because essentially you're believing that the stock price is going to go up. You are willing to buy shares at a certain price, but you're really doing it. Most people play cash secured puts just to collect the premium and let the stock stay above where they're at. So when you go to option strat, you just go to build, and over here there's an income and there's covered calls and cash secured puts. So let me do one more thing on covered calls. So when I do my covered calls, once again, in a squeeze play like AMC, I do not go more than 1 week out at a time. So I only buy and do weekly covered calls because I feel like I have a very good grip over how the weekly price action turns out on AMC. Not everybody, but a lot of people I saw this week were talking about how, we're calling it moon day, for Monday and stuff like that. And there was just a ton of hype. I think I was like the only TA guy that I saw out there saying, no, I think we're going to see downside. I want to see the 618 touch to complete wave 2 before we can look at starting wave 3. And so, yeah, I'm not here to sit here and say I'm right, but I was right. All right. So I do weeklies because I feel like I can tell at least about a week in advance. You know, where AMC is going to be 4 months from now? Who knows? All right. We all hope it's on Mars, but we don't know. So I do weeklies on my covered calls and on my cash secured puts because, like I said, I feel like week to week, when you go too far out, then you're at the mercy of news and things of that nature. But for instance, as of right now, you could sell covered call contracts on January of 2024. All right, all the way up to 90 strikes. So you could say, all right, in January of 2024, I'm willing to sell my 1,000 shares of AMC, for $90. Okay, so times the 90, so $90,000, and you would collect. You could do 10 of those contracts. You could sell that for $433 a contract times 10 contracts. You could put $4,330 in your pocket tomorrow morning if you wanted to. If you were willing to sell your shares January of 2024 for $90. So, if that's what you want to do, a lot of people are willing to do that. I'm not. I do weeklies, but you can go out and you can pick them however you need to, essentially. So that's covered calls. Puts, cash secured puts. So this is basically the opposite of covered calls. This is where you pick a strike, okay? And the strike is the price that you're willing to buy the share, and you pick a date. So once again, we're going to use this week for an example. So the options expiration date would be April the 8th. And so let's say we're willing to buy AMC at, I'm willing to buy 100 shares of AMC at $21. Okay? So that means in your account, you would need to have $2,100 because for you non-math majors, 100 shares at $21, $2,100. Okay? So you got to have the $2,100, okay? Because that is going to be you're agreeing to purchase 100 shares at $21 on Friday, April the 8th, if AMC is at $21 or below. Okay? Now, for that, once again, you also collect a premium. So, a $21 put expiring on April the 8th, you would collect a premium of $111. Once again, immediately goes to your account. So, now, if AMC closes at $21.05, you collect all the premium and your $2,100 does not get assigned. Okay? Your $2,100 would stay in your account. All right? But think of when you write that contract, that $2,100 is going into like an escrow essentially. Okay? If AMC closes on Friday at $20.92, then you're going to get assigned. When you get assigned, your $2,100 is now going to convert into 100 shares of AMC in your account. All right. So when you get assigned, that's when money is gone and shares go into your account. All right. When a covered call, when your shares get called away, then your shares are gone. Money's in your account. I really don't feel like I can say that any more clear than that. So, with some of my dry powder, I will also be willing to buy shares at certain levels of support. Okay? So, each week, going into the week, I look at where do I think is going to be good, solid support for AMC. So, I didn't do this, but going into this week, a great place, which I saw downside, a great place for potential reversal is right where we are right now. Okay, the 618 at the $21.10 or $21.09. Once again, this is all ranges and golden pocket right in that area. So I wouldn't be mad at $20 or anything along those lines. So I think that's a good place personally for me, not for you. This isn't financial advice. But I think that's a good place to buy some shares. So if you were sitting around this week, and when we started this week, where were we at this week? What was Monday? Today's Tuesday. So the 3rd, right? No, 4th. I'm retarded. Sorry. Yeah, so the 4th. Sorry, guys. Been on one of those days. So on the 4th, let's say you were going into the week going, and you just got, money burning a hole in your pocket going, man, I really need to buy me some AMC shares this week, but I don't know what's going to happen. All right? You could look at what you think are some good solid support lines if you understand TA, which is once again why I recommend you learn about it, and go, okay, you know what? Looking at this chart, Fibonacci retracement, 618. All right, yeah, let's be safe. Let's go 20. Let's go 20. It might bounce at that golden pocket, but let's go 20. All right. So we go over here to our option strat. $20 put would be, if I sold that tomorrow morning, would be $67. So my now we need $2,000. So my $2,000 goes on the line. I'm going to make $67 in premium. So that is immediately a 3.3% return on my money right off the bat. Okay? So that's the good news. The good news is you're making an immediate return on the money that you're putting up. So what's the bad news? The bad news is AMC tanks. So let's say AMC by the end of this week goes to $15. Well, you wrote a contract for $20. So even though AMC is at $15, you are going to be assigned. So that means they are going to take your $2,000. You're going to be assigned 100 shares of AMC at the strike price that you picked, at the $20 strike price. So that means come Monday morning, you're immediately down $500 on those shares. Now, you're not really down $500 because you collected $67 in premium. So those premiums also can affect your cost basis in your shares. So that's why so many people do them and like them. So even if you're wrong, no matter what, you got that $67. And even if you go, you know what, AMC's at $15 right now, but that's still a bargain. Where I bought my shares at $20, I still think that was a good price. Long term, I think AMC is going to be well over $20. So I'm very comfortable with my position. Okay? So what can you do then? Well, then this is where the wheel strategy comes in. So let's say you got assigned at 20, AMC goes to 15. So on Monday, you could then write a covered call contract for $20, because that, once again, that's where you bought your shares at. Then you could write a covered call contract for $20, and you would collect premium. Okay, so the wheel strategy is do cash secured puts, play those as long as you can. Like I always teach my son, we're out here just collecting premiums. Okay, I don't really worry about what my share price is doing or anything along those lines because I'm just constantly collecting premiums. The wheel is rolling, if you will. So I'll buy shares with cash secured puts, and then if they don't get assigned, great. I stick that premium money in my pocket. If I do get assigned, then I start the other side of the wheel strategy. Then I'll sell covered calls against those and so on and so forth. Now, you could also do it where, let's say you're at that $15 is where AMC closes. You got assigned at 20, so you're down the $500. Then, and this isn't going to be exact numbers, but I'm going to go back to the covered calls. So let's just say, okay, all right, I got assigned, my shares at at 20, so $2,000. So for April 14th, I'm going to sell a covered call for $20. Well, now you collect $237. So you got the $67 when you did your cash secured put. You got assigned. Now you're going to sell a covered call against those shares, and you're going to collect $237. So in total, 67 plus 237. So now you've collected $304 that you didn't have over the last week and a half. Could be how you look at this. Now, you could get assigned those and go, dude, I ain't doing that. I ain't here to just collect those premiums. I want to do it for more. So you got those shares at 20. That's your cost basis. You can go, I'm not willing to sell these shares unless I make a couple extra $100. So now you can go up to the 22 strike. You will get $154. But you're also going to get the difference between the $20 that you bought it at and the $22. All right? So you get that $200, plus you get your $154 premium, plus you get your $67 that you did the week before. So let's do that math. So you've got your 67 plus your 154 plus your 200. Now you've collected $421 over that. Now, once again, this type of strategy is not for you if you're just a diamond balled ape, okay? And I have a certain amount of my shares. Let me break it down for you. I'll just be as honest as I can. So I have a certain amount of my shares that are just, I ain't freaking selling. Okay? They're my middle finger shares. They're my I'm sending a message shares. Okay? There's just a certain amount of my shares I ain't ever going to sell. And full disclosure, I am not a $500,000 is the floor type of person. You need to come up with your own numbers, but that is not my number. And honestly, my number is not even close to that. Okay? So, but I've got some shares that if I'm wrong, and I have definitely been wrong before, that if I'm wrong, I am going to hold those to the moon and to the Mars and to the MOAS and to the, $1 trillion a share. Okay? I've got those shares. Then I've got a certain amount of shares that are just like, these are my diamond ball shares. These are just, I'm not selling these shares until I see big numbers. And then I have a certain amount of my shares that I'm going to be super responsible with, and I am going to trade with, and I am going to swing with, and let me just put this as blunt as I can. I don't care if you don't like it. If you think that doesn't make me an ape, great. I ain't trying to be one. I'm trying to be a successful investor. I would love for you to go on that journey with me. But if you don't want to, then you do your thing. And I'm going to do my thing. And I'm not going to tell you your plan is wrong. So don't tell me my plan is wrong. I trade my plan. You trade your plan. All right? So at the end of the day, I'm not going to jump into the chart, guys. I know I said there's some important moments and times for AMC coming, but this video is already longer than I intended it to be. If it's helpful to you, please like and subscribe. This isn't a flashy video or anything like that, but I really believe this is one of the most important videos that I've ever put out as far as helping the average investor learn how to become a better and wiser trader. Also, too, guys, these premiums that you're collecting, you can literally pull them out of your account if you need to pay bills or anything along those lines with it. I personally have not done that, but it's absolutely what you can do. You also, my guy who taught me, I call him Coach Bill, it was always, some was for accumulating more shares, some was for fun. He called it you hip pocket. You stick it in your hip pocket, and then some you got to make sure you're smart about taxes with it, okay? So he would have me do like a third, okay? Now, honestly, I'm so young and I love my job so much and everything like that. I'm not trying to put any of that money in my pocket. I use that for accumulating more shares and essentially making my snowball get bigger and bigger and bigger and bigger and bigger. So that's the way I look at it. So, but you got to be smart, and pay the tax man, all that kind of stuff. Also, too, you got to be smart about it. So if you've been in this play over a year, you can trigger some tax consequences and everything like that if your shares get called away. Okay, so be smart about shares that you've held over a year. If it's been less than a year, it doesn't matter anyway. Okay, shares that are over a year long, you need to be smart about those. So like my shares that I bought at like $2.92 or whatever, honestly, those are my middle finger shares. They were the first to come, and they're going to be the last to go. So be smart, trade your plan. Please don't hesitate to ask me questions if you got them. I'm doing my best to always answer as many questions as I possibly can. So be smart about, once again, the tax situation that you can trigger if you are over a year in your long-term capital gains and everything like that. But don't let anybody tell you that selling covered calls or anything like that and learning how to ride the waves. I have literally added thousands. Let me say that one more time. I have literally added thousands of shares of AMC to my portfolio through selling covered calls. That wouldn't be able to happen is if I was just using my usual paycheck money that I put in. Okay? So, now once again, education is the most important thing when it comes to this. So be educated, understand TA, don't just, close your eyes and throw a dart. Unless you're willing to live with the consequences of it. And if you're willing to live with the consequences of, I sold a cover call for 22, man, it is what it is. Also, too, I should have gotten to this earlier. I apologize if you stuck with me this long. I greatly appreciate you. But you can also buy out of the contracts at any point in time during the week. You don't have to wait till Friday. So anytime I've sold a covered call, if AMC, tanks pretty hard, I will sell those contracts and I will repurchase new contracts, things of that nature. So you can trade them that way. So it doesn't have to be just on the week-to-week basis. But if, let's say, you sold it at $20 and AMC jumps up to $23, it is going to be so expensive to try to buy out of that contract. You definitely can. And you can also roll contracts and things of that nature. I highly recommend. Once again, this is all about education. I tried to do this video purely based off of kind of its most simple format and the wheel strategy. But you can roll contracts and all that kind of stuff. So just, be smart about what you're doing and with your shares. I'm just going to leave it at that. I hope this video was helpful. I want everybody to win. So let's go to work. We're at some important times. I think we're coming to the end of wave 2 with AMC. I am going to be looking for and hoping for some very bullish price action here over the next day or two. So I'll see you on the Twitterverse. Be good, be kind, especially on red days. Like I said, trolls don't faze me, but I see trolls really bother other people. And that's why so many people, you'll see them, and they'll post a lot on green days, and you won't see them at all on red days, is because people are freaking trolls, and some people just aren't mentally or emotionally strong enough. Like I said, I don't give two shits about them, but some people can't handle that. And so, like I said, be smart, be kind. We're all in this together, all right? Let's do it. Y'all be good.